One of the biggest opportunities of 2021 was the reopening trade. And once it was clear that the FDA would approve a COVID vaccine, traders piled into restaurants, travel and retail sectors. Now there's another reopening trade. China is opening up after a prolonged lockdown, and once again investors are looking for ways to benefit. Data from Trackstar, a proprietary sentiment indicator, shows a surge in searches for stocks with China-heavy exposure, alongside huge interest in emerging market ETFs, specifically the iShares MSCI Emerging Markets ETF, which we rate at 5 out of 10. It's the Financial Pros' most searched emerging markets ETF over the last month, and as the name implies, EEM doesn't focus solely on China. It's a broader emerging market play that exposes investors to China while diversifying risk amongst other emerging markets, including Taiwan, India and Brazil. The top 10 holdings make up approximately 24.1% of its weight. Financials and information technology are its biggest sector exposures. The ETF began trading on April 7, 2003, and since then it's delivered a solid return. However, performance has been poor for the last 5 years. EEM is one of the most actively traded ETFs, with a daily average volume of 42.5 million shares, and there are options on the fund too. Investors seeking access to emerging markets via ETFs have several options, and on the face of it, these ETFs look quite similar, but in terms of the number of positions held, VWO is the most diversified and EEM is the most concentrated. When it comes to fees, EEM is the most expensive of these 5 funds, while VWO is the cheapest, and it has the highest dividend yield. It's also been the best performing fund over the last 3 years. And emerging market ETFs have struggled over that period due to strict lockdown policies, but with China reopening and monetary tightening slowing, Wall Street believes emerging markets will rebound, and so do we. We like EEM, but VWO is a much better pick in our opinion, thanks to its lower expenses and higher dividend.